Before we dive in, hit subscribe so you don't miss new episodes. If you find value, click the like button so we reach more people. Let's get started. Welcome to the Deep Dive. Today, we're really getting into something fundamental for anyone serious about real estate strategy. We're navigating the complexities of commercial real estate financing, CRE financing. We've taken a detailed 2025 guide and, well, we've boiled it down to the absolute essentials for you, actionable stuff. Our mission here isn't just, how to get a loan. It's really about understanding the strategy, the art and science of allocating capital in this, well, let's face it, constantly changing market.
Absolutely. And that strategic angle is exactly why this is so vital. I mean, for any decision maker listening, looking ahead to 2025, you've got interest rates fluctuating, market dynamics shifting. Having a really sophisticated grasp of CRE financing isn't just nice to have anymore. It's essential, truly fundamental for growing your portfolio sustainably and, maybe just as importantly, managing risk effectively. Honestly, understanding this landscape, that can be the difference between just getting by and actually leading the market.
Okay, let's unpack that. You're framing CRE financing as a strategic imperative. Why is it so much more than, say, just numbers on a page? What makes it this powerful strategic tool you mentioned?
Well, for investors who see real estate as a core part of their overall financial picture, commercial real estate is absolutely a cornerstone asset class. It just offers these unique ways to use leverage, optimize your cash flow streams, and diversify your holdings effectively. We're not just talking about borrowing money here. We're talking about using capital strategically, like a finely tuned instrument, to hit those bigger long-term financial goals.
Right. So when you say strategic tool, what does that look like in practice? What are the concrete benefits of getting the financing package right? It sounds like it goes way beyond just, getting the funds to buy something.
Oh, definitely. The first, and maybe most obvious benefit, is it seriously enhances your purchasing power. Leverage borrowed capital lets you acquire bigger properties, higher value ones, or assets in better locations than you could possibly manage with just your own equity. The real insight here is that smart investors aren't just thinking bigger. They're thinking, well, smarter about how they deploy capital. Using leverage not just to buy, but to really optimize their balance sheet. Maybe free up capital for other high-return plays. Think about getting access to prime assets previously out of reach. That scales your potential returns massively.
Okay, so it's not just more properties, but better, more strategic ones. That's a huge lever for growth. What else?
Second big thing, optimizing cash flow. A well-designed financing deal lets you carefully line up the loan terms, the amortization schedule, the debt service, match all that with the property's expected rental income and operating costs. Getting that alignment right ensures the property throws off consistent, positive cash flow even after you've paid the mortgage. You often see amortization periods stretching out maybe 20, 25 years. But, and this is important, it's common for these loans to have a shorter call or a balloon payment, say in 5 or 10 years. That means the whole remaining balance is due then, usually requiring a refinance.
Right, so you get some long-term predictability, but with built-in points to reassess based on the market.
Exactly. It gives you stability, but also flexibility.
Makes sense. And sticking with smart planning, what about the tax side? CRE is always talked about for its tax advantages.
Yes, absolutely. Third benefit, significant tax efficiencies. You can strategically use deductions for mortgage interest payments. And, this is a big one, asset depreciation. These deductions can really boost the overall return on your investment, impacting your bottom line directly, freeing up cash for reinvestment or whatever else. I mean, being able to depreciate a building's value over time, even while its market value might be going up, that can substantially cut your taxable income.
Interesting. And what about businesses? Not just pure investors, but companies needing space for their operations.
Good point. Fourthly, it really strengthens corporate finance. If a business acquires commercial property, could be an office, a warehouse, retail space that's often a key part of their expansion plan, the property itself becomes valuable collateral, and that collateral can then be used to secure further funding for business growth, working capital, you name it. For executives, it's not just about owning the building. It's about smart capital deployment across the whole company, maybe freeing up cash flow, enabling strategic moves that drive profit. Now, if we kind of zoom out and look at the bigger market picture, there are some really interesting global trends happening that highlight why this strategic planning is so necessary. Take the UK, for instance. Their CRE lending market bounced back quite a bit in 2024.
Oh yeah, how so?
New loan volumes climbed 11% year over year, reaching $36.3 billion. And the breakdown's interesting. UK banks did about 46%, international banks chipped in 31%, and debt funds provided 17%. And this growth, It mirrors what we've seen across Europe, too. So for you listening, the takeaway is just relying on your usual bank might mean you're missing opportunities. The smart players, they're actively exploring a wider range of capital sources because these alternative lenders are really stepping into the gap.
And is that mainly a European trend, or are we seeing similar shifts elsewhere? What about Asian Pacific?
Yeah, good question. In the APAC market, you've got rapid urbanization, massive infrastructure spending that's fueling really competitive CRE financing from both banks and a growing number of alternative lenders. These regional trends, they're not happening in isolation. They're all signals of a global market that wants smart capital and rewards those who know how to deploy it strategically.
Okay. So given that strategic importance and this complex global picture, for someone listening, what's the actual roadmap? How do you start navigating this? Sounds like you need to be really proactive, really meticulous.
You really do. We've broken it down into 3 absolutely critical steps. Think of it as the blueprint for navigating CRE financing effectively today.
Right. And that first step, it's about telling the story behind the deal, isn't it? Making it compelling for lenders.
Precisely. Step 1, develop a comprehensive investment thesis and business plan. Look, lenders, capital partners, whether banks or private funds, they need more than just numbers. They need a narrative, a clear story explaining the why and the how of your project. Your business plan needs to be rock solid. It has to clearly spell out your investment strategy. Are you doing value add, meaning you're buying something to improve it significantly? Renovations, new tenants, repositioning. Is it core, plus maybe lighter improvements on a stable asset? Or ground-up development? Who's your target tenant? Then you need realistic financial projections. Cash flow, NOI, that's net operating income, your income after operating expenses but before debt and taxes, potential exit value. And these need to be stress tested. What happens if things go south?
Okay.
You also need thorough market analysis, your specific submarket competitors, demographics, economic drivers. And finally, clear risk and mitigation plans. What could go wrong, market shifts, operational issues, tenants leaving, and how will you handle it?
Yeah.
It's about showing you've thought through the potential downsides.
So basically, prove you've done exhaustive homework and you understand the project inside out, potential problems included. Okay, that leads logically to step 2, which sounds like understanding their homework, how the lenders actually assess these deals.
Exactly right. Step 2, master key underwriting metrics from a lender's perspective. How strong are you financially? How viable is the property itself? Lenders scrutinize this using specific financial ratios. Understanding how they underwrite is, well, it's everything. It determines the terms, the rate, maybe even if you get the loan at all. There are 2 main metrics you absolutely have to get your head around.
Okay, let's hear them.
First is the loan-to-value ratio, LTV. Simple concept. Loan amount versus the property's appraised value. Lenders like lower LTVs, usually somewhere between 65% and 80%.
Right.
Why? Because it means lower risk for them and more of your own equity, more skin in the game. So you're typically looking at down payments of 20% to 40%. The more equity you put in, the less risk the lender takes. And that usually means better rates and terms for you.
Okay, more skin in the game equals better deal. Makes intuitive sense. What's the second key metric?
The second really crucial one is the debt service coverage ratio, or DSCR. This basically measures if the property generates enough cash flow to comfortably cover its mortgage payments. The formula is pretty straightforward. Net operating income, NOI, divided by the total debt service, your annual principal and interest payments. Lenders typically want to see a DSCR of 1.25x or higher.
So 1.25x means?
It means the property's NOI is 125% of its total debt payments for the year. That gives them a comfortable cushion, a buffer. It proves the asset can handle its debt, even if, say, income dips a bit unexpectedly.
It's kind of like getting a personal loan, just on a much bigger scale, right? Your financial health and the property's own income power directly shape the deal you get. But you mentioned diversification earlier. It's not just about getting one type of loan, is it?
No, definitely not. Which brings us to step 3. Evaluate the full spectrum of CRE financing options. You should absolutely never just take the first offer that comes along. You need a competitive process. There's such a diverse range of financing options out there today, each with its own advantages and disadvantages. You really need to find the structure that fits your specific project timeline, your risk tolerance, your long-term goals.
Okay, so beyond just walking into the local bank, what are some of these other options people should be aware of?
Well, sure. You have your traditional bank loans from commercial banks, credit unions, standard commercial mortgages, usually competitive rates if you're a strong borrower with a stable, lower-risk property. Then you've got bridge loans. These are short-term, designed to help you snap up a property quickly or fund renovations before you can get permanent financing in place. They're fast, flexible.
But probably more expensive.
Generally, yes.
Hmm.
Higher interest rates, more fees. Think of them as a sprint, not a marathon. A temporary fix to bridge a gap.
Gotcha. Okay, what else is in the toolkit?
Then there are SBA loans, specifically the 504 and 7A programs. These are backed by the U.S. Small Business Administration, mainly for properties occupied by the owner's business. The SBA 504 loan is particularly useful for buying major fixed assets, real estate, big equipment. You also have hard money loans. These come from private investors or specialized firms. They're asset-based, meaning approval is super fast and relies mostly on the property's value, less on your credit score.
Sure.
Yeah, they come with higher costs and shorter terms, usually best for quick flips or projects with very clear short-term high yields.
Right. And for the really big, maybe complex development deals, where does the money come from then?
For those larger projects or ones with a big value-add component, you often see mezzanine financing and private equity come into play.
Yeah.
Mezzanine is basically a layer of debt that sits below the main senior bank loan, but above your own equity. It fills a gap in the capital stack. That's the term for all the different layers of funding. It's riskier than senior debt, so it costs more, but is less risky than pure equity. Private equity, on the other hand, is just that, equity investment. They take an ownership stake in the project. And connecting this back to the bigger picture, remember that JLL Asia-Pacific capital tracker I mentioned? It highlighted a huge debt gap over there, estimated at over US $257 billion.
Wow.
Yeah. And a big reason is banks tightening up lending standards because of economic uncertainty. So guess who's stepping in? Non-bank lenders, private credit funds. They're offering more flexible capital for all sorts of deals. It just hammers home the point.
Yeah.
You need a diversified financing strategy today. Relying on just one source, that's becoming increasingly risky.
Okay, that makes sense. But, even experienced investors run into trouble sometimes. Looking at 2025, what are the common traps, the pitfalls people need to really watch out for in CRE, and how can they manage those risks proactively?
Yeah, risk management is absolutely key. A really common pitfall is simply underestimating the total project costs. It's never just the purchase price. You have to budget for closing costs, appraisal fees, legal fees, and critically, a decent contingency fund.
How much contingency are we talking?
I'd say typically 10%, maybe even 15% of the total project cost. If this is to absorb those inevitable unexpected expenses, maybe some environmental cleanup you didn't foresee, construction delays, tenant fit-out costs more than expected. I've seen projects get derailed because they didn't have that buffer, a zoning issue, a permit problem, suddenly months of delay and huge legal bills. Painful lesson.
Right. Budget for the unexpected to avoid nasty surprises. What's another common trap?
Inadequate due diligence. Skimming the surface just won't cut it. You need to dig deep. That means proper environmental site assessments. Is there contamination? Strict checking of zoning compliance. A full audit of every single tenant lease. What are the terms? When do they expire? Are there any issues? And a structural engineering report. Is the building sound? Missing any one of these can lead to massive headaches later. Costly fixes, legal fights, maybe even finding out the property isn't usable for your purpose. You've got to look under every single rock before you commit that capital.
And the financial projections themselves. I guess being too optimistic can bite you.
Oh, absolutely. Overly optimistic projections are a classic trap. Remember, lenders are going to stress test your numbers. They'll push them. Can your model handle higher vacancies, lower rents, unexpected jumps in operating costs? You need to be sure your project can still cover its debt, even if things don't go perfectly according to plan. Always lean towards being conservatively realistic. What looks great in a best-case spreadsheet can fall apart fast if the market shifts even slightly. And finally, a huge one, ignoring market volatility. We're in a global economy. What happens with interest rates, inflation, geopolitical events, it all directly impacts property values and borrowing costs. If you're in the UK or Europe, you're watching ECB policy, maybe still dealing with Brexit fallout. In Asia-Pacific, rapid growth and changing regulations create both opportunities and risks. You just have to stay plugged into these bigger macro trends and be ready to adapt your strategy. A great deal today might look overpriced tomorrow if the economic winds change.
That really brings up a crucial point then. For you, the listener, how do you possibly stay informed and, more importantly, adaptable in such a complex and fast-moving world?
Well, it comes down to continuous learning,
Right.
And actively engaging with reliable market intelligence, really mastering the kinds of details we've been talking about today, understanding the strategic side, the underwriting nuts and bolts, the financing options, the potential pitfalls. That's genuinely the key. It allows you to anticipate market shifts rather than just reacting to them. That's how you unlock value and navigate the challenges effectively, position yourself for, sustained success.
So the bottom line seems to be getting capital for commercial real estate isn't just like picking a mortgage off a shelf. It's not commoditized. It's deeply strategic. It's about developing that solid plan, really understanding how lenders think with those key metrics, exploring all your funding options, making truly informed choices that lead to better returns and solid growth.
Exactly. And the right financing partner does way more than just find you a loan. They should really function as part of your team, helping you integrate that capital structure into your wider business strategy. It's about engineering solutions tailored specifically for your project, your vision. That helps you navigate the complexity and really seize the opportunities.
So as you think about your own financial strategies, maybe consider which of these insights we discussed today, the power of leverage, mastering LTV and DSCR, diversifying your capital sources, which one will be your critical advantage in the commercial real estate landscape ahead? Thanks for listening. If this helped or made you think, hit like it shows this content matters, and tap subscribe if you haven't yet. See you next time.